The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod on behalf of Gold Money. And with me on the line from London is Ned Naylor-Leyland. Ned is an investment director at Cheviot Asset Management, and advises a precious metals fund. Listeners can find Cheviot on cheviot.co.uk. Welcome, Ned.
Thank you very much, Alison. Pleasure to be here.
Firstly, can you tell us a bit about Cheviot and about the funds that you personally run and oversee?
Of course, absolutely. Cheviot Asset Management is really a sort of rebooted old name in the stockbroking world of Lang and Cruikshank, which went through various different other businesses before reforming as Cheviot Asset Management. So we do regular UK private client asset management, but I operate in a sort of slightly independent way from the overall investment process, in as much as I offer a more active and ex-sterling, ex-UK investment approach, as well as advising an offshore precious metals fund, which is 50% gold, 50% silver, and the weighting within that portfolio is 40% bullion and 60% precious metals equities. So that sort of gives a bit of an overview of what I do and the firm overall.
Right, so that's interesting. The selection of 50% gold, 50% silver, is that sort of predetermined, or is that a weighting that you personally recommend them? Yeah,
it's just my own view of how one best invests in the sector. I mean, really it all came about in as much as I didn't think there was anything available which really provided the right balance between potential appreciation and protection for high net worth, relatively sophisticated investors, and I'm probably more of a silver bug even than I am a gold bug. I think both are fantastic, but I think the upside in silver is particularly obvious. So I think that if you're going to be invested in the sector, you ought to have a very substantial weighting towards silver, particularly as they do trade in sympathy. And if we're imagining gold's going to go up, silver will likely go up more. So I think it's a pretty natural way to go about it. Although I will admit, this is quite a unique approach, which to me I find amazing, considering how obvious that is as an underlying idea.
That's, yes. I would agree with you. I mean, it just seems to me that if you're bullish about something, then you want to buy the more volatile, or go overweight in the more volatile route to get you there.
Absolutely. I mean, silver is obviously, it is different. The dynamics of above ground supply is very different. But like you say, if you're going to be invested because you believe the sector is going up, you might as well own the one which is going to go up more, relative to the other one. I mean, it's also fair to say that in the downdraft, like the sort of correction phase we've had in 15 months or so, silver will come off more. So you need to be a big boy and be aware of what you're doing. But I think overall that's probably the right approach.
Yeah. If I can, I'd like to come back to other topics concerning gold and so on in a moment, but the general economic background seems to me to be one of heightened systemic risk. Yet gold and silver have really been correcting or consolidating for about a year now, and one would have thought that you would see a bit more interest in bullion, given what is happening in the wider world. What's your take on this, and how do you see the investment management community? Why are they not embracing gold and silver? Are they likely to? It's a wide-ranging question, but I'd be very interested in your views.
Of course. Well, I think my view would be that this relates to dramatically dropping volume, and the fact that people are very, very cautious and confused on a general basis. I would sort of tend to argue that the gold bug is less confused. I think we're fairly sure we think we know what's going on, but across the board, obviously volumes have been going down, which means that the algorithms and the robots control much more which way markets trade and the extreme correlation thereof. I think that it's quite obviously the case that political statements, political comment is both supporting the market and helping it to range trade at the moment. So I think that the gold and silver prices seem to be operating within that overall algorithmic correlated matrix. Until you have moments where there's a genuine sense of panic on a sort of day, on an intraday basis, you can see over the last 12 months days where the market goes down and gold and silver go up strongly, and I think it reflects the fact that what's making the market move, in my opinion, is the computers, until human beings sort of actually push the button and get back involved. And at that point, gold and silver seem to do what they ought to be doing, which makes me feel a little more sanguine about the correction phase and about where we are within the overall trend. Because I think that particularly in August, when everyone is away, all the politicians disappear and go and play in their paddling pools or whatever it is they do, it seems the market's less supported by political rhetoric, at which point I think we're likely to... I mean, there are lots of reasons why I would imagine we're likely to see a big rally over the next few months anyway, but I think that the way that the markets operate relating to algorithms versus human beings is at the core of it.
Yes, I think that analysis I would agree with entirely. I mean, from my experience of stockbroking, I remember how frustrating it was when everybody seemed to shut up shop and go on holiday, I think from more or less Henley onwards in the UK. I think if I can sort of add another point to algorithms, computer-driven and all the rest of it, we've seen from the LIBOR scandal that markets actually are probably a very, very mucky place to operate in. They seem to be very, very much interfered one way or the other, either by the authorities encouraging banks to interfere or by the authorities themselves. I mean, we know that the authorities continually operate in the foreign exchange markets, but that does seem to extend now to virtually everything. Would you support that view?
Oh, without any question of a doubt. I mean, I've been for a very, very long time ranting on about the corruption and the way that markets are structured. I think an interesting analogy would be to say, so even back in when I first got involved or was reading GATA and the work that they do and that you guys do, I suppose the analogy would be, it's like watching a child or a 13-year-old consume 2 treasure chests full of the nastiest sweets you can possibly imagine. And standing there and saying, you know what, that's probably not going to end well. It may take a little time to manifest, and we've now got to the point where the spots are a bursting force all over the face of your teenager based on the sweets he's been consuming. And yes, I think it's across the board. It seems to be very interesting and I think exciting for those of us that have a view that we would tend to agree on most things about what's going on. I think it's very exciting to see what's happening at the moment, because it's just a case that a lot of what we've known and observed for a long time is now coming out to the public. There's a definite change in culture amongst the media now, which is I'm delighted and surprised in equal measure to see that they're actually sort of waking up to what's been going on for a very long time, and they seem much keener to investigate. So I think that there's going to be a whole load more of these inverted commas scandals to emerge. They were always there, and it's just the case now that people want to know about them.
Yes, I think that's right. And moving on slightly, Europe, I find, is an interesting one. It's quite clear that a number of countries in the Eurozone are bust, and it's very hard to see how even more disasters, more bad news is going to be avoided from that front. Yet there seems to be very little sign of the Europeans moving into out of euros into gold. What they tend to do, I think, is move money from bank accounts in dodgy jurisdictions to Germany or Luxembourg. Do you think that's likely to change at some stage?
Well, I'm not sure I would agree with you completely. The reason why I would say that is for a period of over a year now, when I've met the people from the World Gold Council, when I've spoken to the high-end trading people that I know, they're saying that Euro gold is incredibly well bid. In fact, the demand for physical, bought in euros has been very, very strong. So I think it's a difficult one to define specifically, but I do think that the Eurozone is clearly a big concern. I think the thing I always try and keep an eye on is the community and the traders, and it's most certainly the case that the big banks are effectively very long euro versus the dollar at the moment, and all the retail and speculative community are looking at it the other way and expecting a big rally in the dollar versus the euro. That tends to make me a little suspicious of what may or may not be going on. But I would also make a couple of additional points about the euro. One would be, it's not worth 1 cent of its original purchasing power, unlike its cousins, the dollar and sterling. So that's one point I would make. And so although the structural problems on the surface are manifestly worse, I would tend to suggest that underlying it, there may be things aren't quite as, assuming that they can wedge through, more centralisation, which frankly I would be blown away they weren't able to do, seeing as it's been a sort of ongoing process since the Treaty of Rome, that would, carry on happening. Assuming that took place, I think that the fact that the ECB has these gold reserves from member states when they join, and also the clear movement towards further loans being backed up by the gold reserves of member nations, and that sort of basically falling under the aegis of the ECB as a way of supporting the currencies. I'm probably not as bearish as some, although short term the problems look terrifying, and one wonders whether people pulling money out of the banking system, or rather reallocating it as you're suggesting, will lead to a problem that the authorities are unable to control short term. I think that has to be on the menu. It's a very complicated and interesting subject, and I don't think my view would necessarily be any more valid than anybody else's. It's safe to say that I'm not perhaps quite as bearish as some.
So it's watch this space, I suppose, really. Changing tack slightly, I was interested to notice that in America the banking community have been asked to give feedback to the regulators about the introduction of gold as collateral with no haircut. I found that a very, very interesting development. Is that something that you're watching? Do you think it is important?
Well, I think it's obviously fantastic news. It's, the idea that the physical gold wouldn't be a cash equivalent, already is utterly bizarre. But not in the context of what you and I know about how these things are managed. But I think it's very interesting that this has all been driven by the IMF and the World Bank, who've been stating that balance sheet shrinkage is a huge problem. They need more risk-free assets, and gold is a natural one to join, AAA-rated paper. And I think what's exciting about this is beneficial to the banks and the gold investor, and I can't think of anything else that's been like that since first investing in the sector. I've never come across something which sort of benefits both sides. I think we'll have to, it's a sort of a bit of a watch this space type of thing, but there are all these moves in the background are fantastic in terms of reformalising gold's role within the financial services system. We've got this RDR change in the UK to do with the IFA community, whereby they're far less able to generate commission on the things they're buying for their clients, which will tend to also change the risk-reward, the key part being the reward for IFAs, of investing in the sector, and the amount of money that swishes around in the IFA community is absolutely enormous. So I think there are a number of things going on which is supportive of further bids being put onto the market. But clearly, if the banks are not net sellers and in fact want to be buying physical for their tier one, or rather for their risk-free asset basket, that's fantastic news. And yes, one would imagine that it would be very, very important. I think that probably the bigger issue here is in what form. So when push comes to shove, how well custodied and how what are the exact terms of what would qualify and what wouldn't, and I think that will be crucial.
My reading of it was that the regulators are going to insist on clearly allocated and accountable gold bullion as only being able to qualify for risk-free, haircut-less collateral. So I think this could be a major development. I mean, it seems to me that it's part of a number of things which look as if in the longer term the authorities are beginning to, if you like, let gold back into the currency system. So I would take it as a positive. So I think we can probably agree on that.
Of course, no, I completely agree. I just think I'm just sort of raising the issue of sort of skepticism as to what really goes on in the bullion banking system, even allocated within the LBMA system. I think it needs some, it needs the microscope to be shone on it. And I think what I'm saying is I think that this formalisation process can help to throw more light and more transparency on the overall bullion banking system. Even Jeff Christian the other day in a radio interview stated that he thought that most people who owned unallocated gold didn't really know what they owned, which coming from him I thought was a rather amazing statement. And it just sort of goes to reflect that I think that that's a subject which is going to be on the menu at some point in the next 12 months. I don't know how long it will take, but it's sort of, I think, moving that direction.
Yes, no, that's good. Now, the last topic I would like to discuss with you is something which I know you have spoken on a number of times, and that is China. I think the two aspects of China which are interesting. One is their overall strategy towards gold and silver, and the second is their attitude towards things like the Pan-Asia Gold Exchange, which seemed to be in the planning stages and was going along quite nicely, and then got rather cut out by changes in Chinese regulations. What are your views on China, and is there anything going to happen on the page front, or is that a dead duck?
Well, I'll answer it in two ways. The first one would be the overall strategy. I think is very difficult to know. I think the Chinese aren't exactly big on delivering their strategic thinking to the world. So I sort of almost pass on that, although I do accept the basic presumption that they know gold is money rather than having a discussion about it. They know that's the case. But related to Page, I'll just quickly refresh where we were with it, which is that it got within just a few weeks or a month or two after I made a fair bit of noise about what was going on there last summer, there were issues, let's say, at that board level within Page. So that was the first thing. So the international contract about which I was speaking effectively got blocked internally. Now, there seem to be various reasons why that happened, none of which looked terribly, free market oriented, let's just say. But actually, possibly more interesting was the fact that, again, about a month after that, the Chinese government themselves came out and said, look, we're no longer allow any gold trading at all outside of Shanghai, which could mean a number of different things. Maybe it was just taking control of an out-of-control market, which had become very broken up within China, and there was an enormous number of exchanges in different cities all over China, which I think they felt they were losing control over. But the people who were doing the international fully allocated spot contracts within Page, which is really the interesting part of it, took off and have been effectively constructing the same thing in silver rather than gold, because the new rules within China don't cover silver in the way that they do cover gold. So they've gone off and set up a new one whose name I'm going to withhold until it's actually live. The whole process has taken a little longer than one would have expected, but frankly, one shouldn't be that surprised by this. These things aren't simple, particularly when you're trying to drain the LBMA system of metal to hold it outside of that on behalf of investors. You're dealing with a very complicated setup. But yes, the idea will be that within a month or so there should be an operating, fully allocated silver receipt based in China, which I think can drive the price discovery mechanism away from the dubious Loco London system, as clarified by Jeff Christian himself recently, as I just said, and towards a more fully allocated, system, which I imagine over time is inevitable, because I think once people recognise the way things work at the moment on a more broad basis, at the moment it's only us very interested gold bugs that are really aware of what's going on. But at the margin, more and more people are waking up to the price discovery mechanism as it exists at the moment, and the opportunity to provide competition. And I'm very excited and hopeful that can, roll out over the next few months. Interestingly, there's something called the Australian Bullion Exchange as well, which is a gold sort of equivalent of Page, which is under development too. So I think that this overall move towards fully allocated exchanges, yes, they won't have the liquidity within the LBMA bullion banking system, but that's not the point. People aren't needing necessarily to shift hundreds of billions of dollars on a daily basis, but there are lots of market participants who would like something that they felt wasn't a liability of a bullion bank, but was rather fully owned by the investor.
Yeah, I mean, surely there's... I'm interested you mentioning the Australian exchange. It seems to me that the more of these exchanges that set up, basing themselves on fully allocated bullion, is just going to increase demand for bullion, irrespective of what happens on the big economic picture.
Of course, absolutely, and this is what this is why it's exciting for me. The Page thing has been a frustration, but I'm accepting of it in as much as it was always likely to run into problems for obvious reasons, and it's no surprise that this has proven to be a somewhat bumpy road. But I think the key thing here, Alasdair, is to keep talking about it, keep discussing the merits and the differences between a fully allocated tradable receipt, with allocated bar numbers, etc., versus the existing system, and it sort of drags the inevitable improvement in the structure of the bullion markets towards us by educating people and opening this up as a discussion, because people don't want to be a creditor of a insolvent bank. They want to own real metal.
Yes, exactly. Well, Ned, that was very, very interesting, and I thoroughly enjoyed it, and I think our listeners will find that they gain a lot from this podcast. So, on behalf of them all, thank you very much indeed.
Not at all. It's an absolute pleasure, Alison. We'll do it again at some point in the future.
Absolutely.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos and iTunes podcasts from our Gold Research section.